Hi, my name is Yasha and I help young men with investments. So today we are going to take a look at Atkore Incorporated with the stock ticker ATKR because this is the third largest position in my portfolio, and recently, as you can see here on the chart, they dropped by 40%, which is the highest that I have seen in my life so far. So I was thinking, let's re-evaluate the company because the last time that I re-evaluated it, it was last year. So let's do it today again, and maybe you will also see that if this company is good or not, okay? Now, as always, we are going to analyze Atkore using this little Canva presentation that I have right now here. So let's begin. First of all, why should you even listen to me? So as you know, my name is Yasha and I help young men with investments. And when you have more trust for me, I invite you to click the first link in the description where I teach you absolutely everything about it, okay? Now let's come to the actual analysis. So whenever you are a young man who is starting to invest in the stock market, or if you are just a beginner, okay, I know that the biggest fear is to decide which stocks to buy because obviously you don't want to lose the money, right? So that's why I'm here. That's why I created this little framework to help you. And whenever you analyze stocks, you should care about the following six things, okay? You should care about the chart, profit, debt, money on the bank account, value, and price. So now let's begin. Here you have some quick facts about Atkore. It's an electrical equipment company, basically some engineering industrial company that was founded in 1959. And apparently, I didn't know that, but apparently they are operating worldwide, mostly in America, but also in Japan and a bit of Europe. But so far here in Europe, I have never heard about them, okay? And here is immediately the first thing that you should pay attention to. So as you can see, Atkore was incorporated in 1959. And as a rule of thumb, the older the company is, the better and safer investment it is. Because if they have been operating since 1959, that means that they have experienced at least 5 to 6 different stock market crashes. And after all of those years, they are still here. But if you have, for example, one startup that was established maybe last year, they haven't experienced any stock market crash whatsoever. So with them, we don't know how the management would react to such a crash. But with Atkore, since they are still here after 60 years, then we can already see that, okay, the management might be a bit experienced, they might save the company in another stock market crash, okay? You know what I mean? So the older the company, the better. For me personally, I like to invest in companies that were established between 1950 to 1970, but of course, the younger the company is, generally the least favorable investment it is for me personally, okay? Old is gold. That's the fact, okay? Now let's come to the chart, and for chart we have an instruction that chart has to grow for all 10 years, okay? Because whenever the chart grows, that obviously means that the company is a good one because everyone is buying it, and if everyone is buying it, probably the company is profitable, it's growing, it's expanding the business, which is all good for us, okay? Now, how do we see if the chart is growing? Obviously, we have the chart here, but we can also compare it with a little exponentially growing line, kinda like that, because we want to see that the growth is exponential, okay? Now we are going to compare the stock price chart with this black line, okay? And then we will see what happened. So as you can see, the chart was actually growing quite well, quite exponentially, except now in 2024, the stock crashed by around 40% from January up to now. So that's actually quite concerning because, okay, 10% dip is kinda okay, it's kinda manageable, but 40%, it's a bit too much. So here I'm a bit concerned. So I will put chart as a bad thing, even though I would personally start buying the shares right now here, because maybe the company will go back up, maybe they will improve the business, and then the company will just grow again, okay? So when you buy low, you buy more shares and then you just unload them when they are high, okay? So, but at the moment, chart is actually not that encouraging. And now we come to the profit, and for profit we have an instruction that it has to be in plus and it has to grow as well. Now what does that mean? That means the very same concept as with the chart. We will draw a little exponentially growing line, kinda like that. And now we are going to compare the actual profit chart with this black line, and preferably they should yet again follow each other, okay? And here you can see that last year when I started to invest in this company, I was kind of blindfolded by this massive success that they had in the recent years, and I still bought the stock even though they had a loss in 2014. And in my previous stock analyses, I always tell you, if they have a loss in the last 10 years, then company is a no-go. But last year I was kind of a bit naive. I was saying, oh yeah, the growth is amazing, the company is growing, and now I have minus 20% in my portfolio because of them, okay? So if I could revert back in the time, or if I would invest right now with the whole knowledge that I have and no stocks of Atkore, I think that I wouldn't buy this company because they had a loss. Also here in 2015, the chart is a bit small, but I think they also had a loss here. So for me personally, I wouldn't buy this. Profit is bad because they have a loss here, okay? Even though it grew massively in the last years, but nah, I don't think so. And now we come to the debt, and for debt you have an instruction that it has to be low, and preferably it should also decrease through the years. Now here, as you can see, we have exactly the opposite. First we had a bit of decreasing debt, but then increasing, and now decreasing again. So for me, I don't know, I think the debt is quite steady in the last few years. So if the debt is steady, but the profits are also growing or decreasing, then if they are decreasing, I think the debt is kind of bad as well. So I will mark this as a bad thing because, yeah, we want to have a decreasing debt. Microsoft is managing it. Google has a decreasing debt. So if they can do it, then everyone can do it, right? Okay, so now we come to the money, and for the money, we literally measure money that they have on their bank account, okay? Just like you have, for example, 400, 500 euros on your bank account, they have the very same money that we analyze, okay? And preferably, they should have more money than the costs, because having more money than the costs on the bank account, which means having positive bank account balance, is just better for you, okay? Think about yourself. You sleep calmer, you feel better, you feel more confident, you feel relaxed if you have more money on the bank account, okay? And the same concept is with the companies. The more money they have, the better it is. That's a rule of thumb, right? Now, do they have more money than the costs? Bro, use your brain. You are a smart young man. They have plus $390 million on their bank account. And this is absolutely amazing, okay? Almost $500 million is more than enough to solve maybe some quick unexpected events that might happen. Just like right now, the crash happened, so they can quickly improve, or at least try to improve the confidence in the company, the business, and yeah, it's that simple, okay? Now we come to the value, and obviously we as smart investors, we want to invest in companies that are undervalued, okay? Now, how do we measure valuation? By two concepts. The first concept is called P/E ratio, and the second one is called my mouse is glitching. It's called intrinsic value, okay? Now, as a complete beginner, those two concepts might sound a bit complicated, but just stick with me, they are very simple. P/E ratio, by the way, you can find both of the numbers just on the Google, write Atkore Incorporated P/E, Atkore Incorporated intrinsic value, and you find the numbers, okay? You don't have to do any crazy calculations. Now let's go back to definitions. So P/E ratio is used to compare the earnings of Atkore with its competitors and with the whole stock market, okay? And how do we know if the company is undervalued? if it has P/E ratio lower than 15. Now, why exactly 15? Because 15 is the average P/E ratio of the whole stock market. And then if we have stock market here, in order for Atkore to be undervalued, it has to be below 15, right? So it has to be right now here. And what do we have? Due to the recent crash, we have P/E ratio of 6.70, which is way below 15, almost like 3 times below 15. So definitely the stock is undervalued. Okay, I remember back in the days when I was buying it, it was around 10 to 14, and now because of that crash, it went down to 6. Okay, and now we come to the intrinsic value. And in order for stock to be undervalued with intrinsic value, it has to be higher than the current stock price. Okay, now let's take a look at the example. So intrinsic value of Atkore is $167 per share. Now what does that mean? This represents the price per share that the Atkore should have. Okay, should have. But the current price is $95, which means, based on that, means that the price that they should have per share is much higher than the current price that they have. You know what I mean? So intrinsic value tells you the price that they should have per share, but the current stock price tells you the current price. It's that simple, okay? And stock is undervalued if intrinsic value, basically the price that they should have, is higher than the current price. That's logical, right? So, sorry, wait, here I made a mistake. So P/E ratio is indeed below. And the same is for intrinsic value, okay? Because intrinsic value is higher than the current stock price, that's why they are undervalued, okay? So that's a good sign. And now we come to the price. And for price, we have an instruction, that it has to be lower than $150, because that's just the limit that I set for myself. In my opinion, the stocks that are over 150 euros are way too expensive. I don't want to buy them. I want to buy cheap stocks that have the potential to grow, because the cheaper the stock is, the more stocks I can buy. It's that simple, okay? And due to the recent crash, the stock price went from around 200 to $95, or from around 170 to 95, I'm not sure anymore, but it definitely crashed massively. So yeah, it is below 150, which means that we can actually buy this stock at some point, okay? And now we come to the final evaluation, where we are just going to summarize everything that we found out about the company so far, okay? Now, does the chart grow? Technically, yes, but in the last 3 years it started to fall, so we don't want to see that, okay? Does the profit grow? Technically, yes, but they had a loss in 2014, so with the knowledge that we have right now, that's immediately a no-go for us. Does the debt decrease? Technically, yes, but it increased as well, okay? So that's a no-go as well for us. Do they have money on the bank account? Yes, they do. Is the stock undervalued? Yes, it is. And is the stock price below 150 euros? Yes, it is. Now, should you buy or sell? With all the knowledge that I have gathered in this 1 year of intensive stock market investing, I think that you should sell this stock because of the very few reasons. First reason is that they had a loss in 2014. Another reason is that even though the company was growing by around 20% per year, you cannot expect to have that growth every single year, okay? So last year, what happened with me, I was greedy and I wanted to have money, I wanted to make the money, so I invested in this company and now I have minus 20% with them, okay? Even though, look, the margins are quite okay, you know, gross profit margin is well above 40, nah, it's actually below 40, the net income margin is below 40. You see, like, the growth is actually quite good in the last few years. But what happened is, for example, also here, what I don't like is that retained earnings show you how much money they reinvest back instead of paying it as dividends, you know. And as you can see right now here, Until 2021, they were spending more money than they were earning, you know? That's why the retained earnings are negative. So that's completely unsustainable. I don't like that at all. At fucking all, okay? The only good thing is that they have quite good profits, they have quite good returns on equity, you know, around 40-45%, whereas the good number is around 10%. And another good thing is that debt is massively decreasing. Right now it's around 50, which is actually sell, but it's around 50, which is what we want to see. Okay, technically you want to see the debt between 50 and 60%, but 52 is also fine. Okay, but still I think that the company is actually not that good. It was good last year when I started buying it because the growth was absolutely crazy. I should have sold it, but what can you do, you know? Now I just have to wait and then sell it whenever I get the profit. It's that simple. But if I would start from zero, I wouldn't buy this stock because of the reasons that I told you. Negative profit, they cannot grow 20% per year, unlimited amount of time. They spend way too much money in the early days instead of reinvesting it back. And yeah, that's about it. I don't know, maybe I lost a bit of confidence because of the market, so I just have to push it through. But I know that I will definitely not sell, and if you want to take the risk, then go ahead, buy it. But if you are a conservative investor, if you don't want to risk unnecessarily, then I wouldn't buy this stock. There are way too many better options, like Vici Properties, for example, Main Street Capital. Those are amazing buys. I would buy them personally instead of this. So, if you want to know more about investments, I encourage you to click the first link in the description. Otherwise, click subscribe, join me on my journey to become the millionaire with stock market investing and other investments, of course. Do the hard work and see you on top of the world.